Hey everybody, this is Marcus Tuttle with Simplified Home Sales. I want to introduce you to David Burroughs in Kansas City, Missouri, or Kansas, David?
Office is in Kansas City, Missouri. I actually live on the Kansas side, right across state line now.
Cool. David's closed a couple of loans really successfully and efficiently, and beat the rate for standard conventional mortgages. And I thought it would be interesting for me to pick his brain and make a short recording of it. So welcome, David. Thank you. This is your first experience with doing like live recording for marketing purposes. Is that right?
It is. It is. Looking forward to it here, though.
Yeah. I thought your product was real unique just because you are operating in all 50 states and you guys seem to have an economy of scale there. Do you want to fill me in where maybe I've said something right or wrong?
Yeah. So kind of the cliff notes on our company is, again, I'm with NBKC Bank. Personally, I've done real estate finance the last 18 years. The bank that I work for, we've been a national lender since about 1999, back when Amazon was only selling books online. So, this is our bread and butter. We're licensed and lend in all 50 states. We, as a direct servicer, not only do we originate, but we process, underwrite, close, fund, and service all of our loans at the bank. And with caveat there, any type of large non-conforming $1.5 million, $2 million, $3 million loans, we'll sell the servicing on those, but kind of few and far between on those products when we come across them. Some of the highlights on how we operate is whether the loan's $1 million or $100,000. What really separates my bank is that we have a flat rate $250 lender cost. So it takes us the same amount of time and energy to get $1 million loan completed as it is a $100,000 purchase. So, a lot of lenders can get creative and charge one of 10 different fee names, but ultimately cost that you're getting charged, to do business. So on VA lending, that $250 is waived, so zero loan costs on the lending side from us on any VA loan. There's a $5,000 close on time guarantee with my bank, and the reason we implemented that is just we stand behind our process from start to finish. We're very streamlined, and ultimately, if we have a true 30-day contract, we guarantee that we will not drop the ball and miss a borrower's close date, or we would cut a check for $2,500 to the seller and $2,500 to the buyer. So, yeah, that's kind of the Cliff Notes version of our bank, but we have a lot of great technology implemented up front that overly streamlines the process, from start to finish with the borrower. And being a direct servicer with Fannie Mae and Freddie Mac, we truly have no overlays. So most companies will try and close the loan and ultimately sell it, 2, 3, 4, 5 times on the secondary market. So
that's called table funding, right? It's still
exactly,
called
yes.
Table funding. When you initially use some of the bank's money to recoup it just real soon after you make the deal, make the loan. But this is not what your bank does. You hold those and service them in-house largely.
Correct. Exactly. So I'd say, probably 97, 98% of our portfolio that our loans that we're closing are serviced in-house. And, on my end, I'm fortunate enough that a lot of my business is repeat and referral. And it's by doing right by clients from start to finish, as well as being there, after the process. So my personal cell phone is on all my correspondence. So if a borrower has questions, 6 months or a year after closing, I'd prefer they reach out to me. It's always good to reconnect with a client, see if there's any questions that I can help address, as opposed to them waiting on hold, for 5 minutes or wasting a little bit of time calling a servicing department, when most times, I can address that question, and help out a little bit more efficiently.
Right. So what do you call that $250 again? What the loan fee? What is it called?
I mean, it's our administrative processing cost, but I mean, ultimately it's going to be listed in the same category as basically like Section A on a loan estimate or a closing disclosure, which is like any type of origination costs. That's where discount points, underwriting, processing, loan fee, bank fee, transaction fee. Again, lenders can throw again, a ton of different names at it, but that's our flat rate on every loan. So
That's right. And just for a minute, I did make loans, and it seemed like it is a sales position, much like real estate sales, except that your product is the loan, and to price it, you wanted to make some money, and some of that was behind the scenes as you table funded deals with different larger wholesalers, I guess, and that's how you make money. And what you're saying is that you guys keep that as low as you can, and to give the best rate, I guess.
exactly, and we're volume based. So, we don't have to make a ton of money on each loan like a lot of smaller, say, companies would. We'll make our money off the volume base, and ultimately borrowers making timely payments to our bank over the longevity of the loan period. So whether we hold the loan for a year and then refinance, or hold it for 5 years and the home is sold, we'll recoup our funds off that. And that's how our model's been, set up from the beginning. And, we always have to stay competitive, which is, again, a huge piece of our product as well, is that, we don't have retail branches all over the United States. There's a ton of overhead that goes along with that. Being able to lend in all 50 states, we actually have a main hub, our national division. We have about 550 employees out of a 5-story building in Kansas City. So, our overhead is not high in the first place. And, at the last, taking this year out, but the previous 2 years, our bank, just as most, we're able to work remote and, with zero fall off. And, that's actually a strong feature going forward, is that, a lot of the bank employees, have the ability and can work ultimately wherever, going forward. And it doesn't have to be face to face in an office building, to do the same type of work and lead the same type of customer service.
Yeah, well, I really felt you're super competent, and it felt like a real efficient transaction, and that I just didn't hear about a lot of stuff in the two that we closed recently.
Yeah, and a couple. One of them specifically was a little unique, and my job is to step the client through all the options, and then give my advice on kind of path of least resistance, and ultimately what I would recommend. And that's ultimately the route that made the most sense. Whenever I believe they had talked to probably 2 or 3 other companies previously, based on you referring them to me. And before I could even connect with them, just based on the work schedule, I think they had confirmed that they were going to go with somebody else. And then what that company ultimately told them was not accurate. And, I had relayed that in the message that I had sent them. And sure enough, they followed back up with me, and I explained in more detail why that would be. And then, they did a little more research and circled back around. And, we're ultimately happy with the end product when we got them in the home.
Yeah, it was great, and it was remind me 5% down, and that was not
on that scenario, correct.
Well, it wasn't the 20% that we're hearing about as the default down payment now.
Correct. Yes. So ultimately, kind of standard guidelines for a conventional loan. First-time home buyer is 3% down, and the definition of that is somebody who has not owned a home in the last 3 years. So, if a borrower has owned a home in the last 3 years, that basically gets updated to a 5% down payment. And again, on that, kind of referring back to that scenario that I assisted with the financing, that just comes with knowledge and knowing FHA, conventional, and VA guidelines inside now, because the other company was referencing that this borrower could do an FHA loan, and I explained why they could not do that, because they were trying to use rental income from a vacating property that was within a certain amount of distance to the new property. So there were a lot of layers to it, and once they kind of dove in, everything that the other lender had told them was not accurate, and they started to realize that. And again, I fine-tuned exactly why that was, and then we proceeded with a conventional option with the 5% down, and using vacating rental income with limited documentation on that. Just, again, streamline the process to get all the ratios in line.
Right. And since you don't have to retire off of every loan, it gives you a chance to kind of be more consultative. Is that something that you
Oh
think
yeah,
about?
absolutely. And I mean, doing this as long as I have, I mean, I've got referrals from people who I actually didn't even do business with because I told them why either refinancing, ultimately didn't make sense. And yeah, my job ultimately is to maximize somebody's money, put them in the best position possible going forward. And again, whether that's doing a loan for them or advising them not to do a loan. We have primary home options. I mean, we have people inquiring still to this day about refinancing, and you kind of see, hey, the rate's fixed on a 3% or 3.5%, and cash out rates are in the sevens, and think, well, it really doesn't make sense. But somebody's needing. I had a client earlier, hey, needing $40,000 for medical bills, and they had $10,000 in credit cards, and their rate was okay, but that rate doesn't ultimately pay these future bills and these large minimum payments on credit cards that are high revolving rates. So, taking out a second home equity loan is another feature that we have, that we offer, and consolidates that, gets it on a payment that they feel comfortable with, as well. So we have primary home options, secondary options, and there's no one loan that's going to fit everybody's needs or goals.
Right. And do you focus on the owner-occupied conventional FHA type loan, or do you get off into investors and such?
Yeah, we do all primary, secondary homes, investment properties. And at this point, just due to the secondary market and how drastically high rates have jumped just year to date, I've had borrowers who are inquiring about investment properties, and it's very hard to even come up with a par rate at this point. And I tell borrowers to, hey, do your research before you commit. And I like to send information about myself and the banks. Hey, here's a link to my Zillow page so you can see what previous clients have referenced about working with myself and the bank. And so a client up front can do their due diligence and then know that, hey, ultimately, I'm not blowing smoke with the products. If there was a lower rate or a better option, that's my job to give it to you. But like a bank like mine, I'll be the first to say that, we're always competitive when it comes to primary homes, secondary homes, and so forth. But are we always the best in every scenario? Absolutely not. And again, $100,000, investment property with 25% down, is that in our wheelhouse of what we are wanting on our books, or specifically pricing aggressive on? It's not. And again, I'll be the first to relay that to clients and say, hey, do your due diligence, but here's where my offer is. So, at least they have a starting point.
Yeah, I like the investor Ken McElroy. He's got a YouTube page, but he says get out there and shop for your loan. There's different offers from different operations. So
yeah, and that's the number one thing is, I talk to clients all day, and again, some of them I'm the first one that they talk to, some of them I'm the fourth or fifth. And the biggest piece of advice is, again, there's no magic loan out there. Most companies are going to be, in line in terms of rate, but there's a lot of companies that get creative and throwing a lower rate out there that's basically below market. And then when push comes to shove, the point cost and the fees start to come to the surface. And so it's not comparing apples to apples. So
they don't lead with that.
Exactly. No, they get their foot in the door, and then borrowers feel like they're far enough in a process they really don't want to start over because they assume most or all lenders are like that, when they just they started with the wrong lender flat out.
Right.
And it can be frustrating for borrowers, and I hear it day in and day out. Whenever if you talk to at least two, maybe three. If a company is shying away from telling you, hey, here's where our options are, and this is what we're charging you to do business, that would be a red flag in the first place. You stand behind your product and your process. And again, that's why doing the due diligence up front, because ultimately, if a borrower starts with a bank or a lender and locks the loan, starts a process and doesn't close with them, it can actually hurt pricing for that lender, like I said, my bank, I mean, it's better off for me to not do business with somebody than lock a loan, start the process, and for whatever reason, a client does not close the loan. We're keeping these loans on our overall hedge and, guaranteeing these with, Fannie Mae, Freddie Mac. So it hurts the overall pricing that I can ultimately future or offer a future client as well. So, yeah.
So one interesting wrinkle, I don't know if it's new or not, but it seemed like you got a worse rate if you did put a full 20% and knocked off the mortgage insurance. Has that been forever or as a recent deal? I think it's not really common knowledge just to get off.
It's been common. It's been standard. It's nothing new. And again, there's a few things that typically play into that. Larger loans will price out better and have a little bit better of a rate than a smaller loan. So if somebody's putting down 5 or 10%, their loan's going to be larger than somebody putting down 20%. And most say, well, 20%, I should be getting a better option. Well, there's a lot of moving pieces with a larger loan, and then the credit score, as well as the loan to value. So every scenario is worth looking at different options. If the borrower's flexible with their down payment, say, hey, I can put down 20%. Well, then, not just an order taker is going to go over and say, if you put down 20%, here's your rate and here's your payment. Well, if you're open to this, here are some other options. Well, if you put down 15 or 10%, the rate's actually slightly better. And sometimes the rate might be the same, but the bank is making $1,200 more, and we can then give that to the borrower as a credit at closing to help pay closing costs. So the pricing's better, but it might not be enough to actually move the market or move the needle to another interest rate. So we can give that in terms of a credit. But basically, when you're putting down less than 20%, there's a version of mortgage insurance is required. So whether it's paid monthly, upfront, or even financed into the loan amount, it's less risky to a bank or a lender because that is required. So if it's not on there, even though the equity position's there, and God forbid something happens, home goes, goes to foreclosure, then the bank is fully on the hook for that. So it's a little bit less risky when that mortgage insurance is added to the loan.
Right. Yeah, that makes sense. Yeah, and a couple of things that it seems like that it may shift, I'm not sure, but is there a limit to the number of conventional loans that one person can have?
Not necessarily, no. So again, a lot of those guidelines have been updated. They used to be 6 properties, but again, especially like when borrowers are purchasing a primary home as well. I mean, there's no cap on conventional. Kind of in that same realm is a big misnomer that's out there is like a veteran, whether they used a VA loan 20 years ago, if that home was ever sold, then that entitlement comes available again. If there was, say, a foreclosure, it does not mean a veteran cannot use VA entitlement again. There might be some remaining entitlement left. Borrowers can have more than one VA loan as well. It's just anytime you're using it to purchase a home, it has to be designated for a primary residence, just as any government loan, like an FHA loan, is only designated to use as a purchase for a primary residence. But it can always be refinanced. Government loans are streamlined refinance options available. A lot of them have no appraisal, some no income documentation, and so forth. So there's a lot of flexibility with that once they actually already own the home.
I see. Well, so there's not a hard and fast rule for the amount of conventional loans, and then there's also some confusion or misunderstanding about how many times you can utilize your VA benefits.
Correct. VA loans can be bought and sold. They can be assumed as well. So if a veteran has a home locked in at 3% and selling their home, assuming that the purchaser of their home can come up with the down payment amount from the purchase price to what the current loan amount is, they can actually assume that rate at 3 or 3.5%, whatever it would be.
And is there a limit to how many VA loans you can assume?
No, but again, that would be
You need to
if somebody
qualify
is
for it.
using that. Yeah, so the vacating veteran whose home it is, that would be tying up their entitlement until that home is either sold or paid off, or refinanced out of that loan. But the person who assumes that loan, again, that would be a primary residence. So unless they were going to assume a new primary residence, from a different veteran going to like a larger home or a different state, yes, that could be done as well.
Mm-hmm.
Another big misnomer that's out there is that FHA loans are first-time homebuyer loans. So they are not. That's the Federal Housing Administration. So, conventional, again, we went over like the 3% or potential 5% down payment options. FHA is a 3.5% down payment option. The biggest difference with that is county loan limits. So,
right.
Might not be an allowable fit if somebody's purchasing at $550,000 or $600,000, but if they're purchasing at $400,000 or lower, then that would be a potential option, whether it's 3.5% down or more.
I see. Well, since you guys do hold a lot of those loans, you're sharing the risk. Appraisals kind of look backwards at the past year, 6 months or 3 months or 60 days, but don't typically look forward. Are you guys sensing how you'll navigate appraisals in this next cycle that with
No.
values potentially going down a bit?
No. So the one thing that's actually very good is that there's a lot of different people or companies involved in a purchase or a refinance transaction. So whenever we order an appraisal, say on a purchase, that order is submitted to an appraisal management company, and they have a database of appraisers all over the United States. So we have no direct affiliation with any of these appraisers. They are just specific and local to the area of where the subject property would be. And again, we're relying on them just as, again, Fannie Mae or Freddie Mac, who's insuring the loan, FHA, again, insuring the loan, or on the VA's case, it's actually submitted to the VA and it goes into basically the VA portal, and the VA will select a certified VA appraiser in that area to handle that. So again, we'll stay out of that, and they're actually notified once the appraisal is completed, because back in 2004, 05, 06, there was a lot of fraud going on, and a lot of lenders who would be reaching out to appraisers to say, "Hey, I really need you to hit this value to make this loan work." And
that was the holy trinity of corruption: a realtor, mortgage person, and an appraiser.
Exactly. So moving some numbers around or stretching it just to make something work. So there's a lot of good separation these days that keep those parts away. So if the value is truly not there, twofold, a borrower could potentially get frustrated and say, or even an agent, hey, the value's here. Well, the appraiser's a neutral third party. We're relying on them to make sure we're not upside down on an asset and that we're not putting a borrower in a bad position. So, again, it has to meet certain thresholds, and, it's a key, crucial part, but there's still a ton of appraisal waivers being hit specifically on, conventional lending. If a borrower is putting down 20% or more, then, it's an automated system that takes into account all registered conventional sales, starting at the subject property on a map. And it will go out in a circle, assuming no major dividing lines or state lines. And the closer a home that's been sold, like the subject property, the better a comparable is. It won't kick out something in the neighborhood to go out 2 miles to try and find value, but it takes all the registered sales, and it's a very high-tech system. And, we're seeing a ton of appraisal waivers that say, hey, this value is supportive, and it's within a small variance of what the purchase price is.
So you guys, regardless of volatility, you guys are going to lend on appraised value with faith in the appraisal process.
Yeah, absolutely. So whenever the appraised value, again, and have we seen some pockets where the values have come back less than the purchase price? Yes, absolutely. Well, some of that is more strategic in terms of, hey, that they just want to get an offer accepted and see where the chips fall once the actual value comes back, then negotiate the price down, which is some strategies, that some realtors have had. Others, again, the seller's firm, and then, a reconsideration of value can always be done on a conventional loan, which means value comes in short. I would reach out to the buyer and the buyer's agent and say, hey, here's where this is. Do you have any supportive sales that will support the sales price? And we can go back and say, hey, please consider these. Then the appraiser would either update the report with those comparables, or they would notate why they don't deem those comparables as good as what they've used in the report, and the value would stay the same. So when values come in short, it's not the end all be all. And the good thing about, especially like on a government loan, like a VA loan, is that if the appraiser is struggling to find value to support the contract price, they actually reach out to us and they invoke something which is called Tidewater, which basically gives us 48 hours to help and assist with providing them comparable sales to help support the sales price before the appraisal is completed. So again, I would reach out to the buyer's agents and the buyer and say, hey, here's where we're at. And again, some of them might say, no, we want to see where it comes and we'll just negotiate a lower price. Others will reach out to the listing agent and say, hey, please help provide, comparative sales to help this because the appraiser is struggling. And again, we provide them whatever's given to us, 2 or 3 comps. And again, same thing. They will either add them to the report or notate why they are not using them. Like say, hey, these are ranch style homes. The subject property is a 2-story home. It's not a like comparable for, they would notate those reasons on the report.
And what do you call it whenever you when you collateralize a few properties, a portfolio loan? Do you guys do any of that? Investing has been part of my career, so just curious.
Sure. So no, we used to. They got away from it with a lot of the QM lending that's come around, but basically like a lot of cross collateralization.
What's QM?
Multiple a qualified mortgage. So again, that's a lot of the guidelines that have to meet underwriting conventional guidelines. A lot of this has come up recently. I mean, a non-QM loan would be like a hard money loan or a portfolio type of a loan that has, an off bank statement program, but, rates and fees are drastically higher that aren't within a regular threshold. So
right.
Our bank, we do have portfolio loans. And again, the gist of those is more of a temporary loan. A lot of them are 5-year arms.
Right.
Temporary loan to get a borrower in a home. Say a borrower is 3 years removed from a bankruptcy, but they've reestablished credit, can put 20% down, have assets, but they don't meet the Fannie Mae Freddie Mac guideline of a standard 4-year seasoning period after a bankruptcy. We would consider that, look at the overall profile and say, yes, hey, we'll do this loan on a 5-year arm, and then borrowers looking to refinance, within the next 5 years, ultimately within the next year once they're eligible, and meet that threshold. Again, same if it doesn't meet a 2-year seasoning period on a FHA type of a scenario or government loan. So again, gives an alternative option.
Yeah, that's what my local bank has done. It's been not fixed rate. It's going to adjust at a certain point.
Mm-hmm. Yep, and again, they're not long-term plays. Again, it's more of a, hey, we can do this as a courtesy, get you in a home, but ultimately, hopefully, win their business and show them our process and flip that to a traditional loan, a little ways down the road. So
I see. And when you guys have to take something back, I'm sure it happens sometimes, unfortunately. How do you process those? Since it's a conforming loan, you have to go through the procedures of what the guarantor requires, right?
Yeah, that's really on the back end on like the purchasing and servicing side of the bank that I really stay out of. But it's very, very limited on what have. I mean, being a direct servicer with Fannie and Freddie, I mean, we literally have a liaison at our bank that if anything's in a gray area, she is the most knowledgeable person that is the best resource at the bank that knows the insides, outsides of all the guidelines of what will and will not work. So, I see those every quarter, and I mean, for us, it was anywhere from 1,500 to 2,000 loans a month. In our division, I mean, you see a handful of buybacks, but a lot of them are, I guess, not disputed, but it's either negotiated or questioned, and there's correspondence. And then Fannie or Freddie says, "Okay, we agree." And so a lot of them don't even fully process through. But yeah, it's really a totally separate department. I'm just aware of the limited ones that are coming. They kind of give us a little bit of a head count on making sure, so we're staying on top of guidelines. Underwriters are, as well as the funding department.
I see. So I don't want to monopolize all your time, David, but one of the plays to navigate the current market conditions, if you needed some kind of money to pay short-term bills or just get some cash, is to do a second mortgage instead of refinancing your first mortgage that might have an advantageous rate of 3 or 4 or something like that. That's one method to achieve some cash with the equity in your property and not still be subject to a huge monthly bill by just financing on the new rate the amount of money that you need in a second. Is that right?
Exactly. And again, I can't stress enough that no two loans are the same. Again, if somebody's at a 3 or 3.5% first and they're looking to take out 50, 60 grand, so why would they go to 6.5%? Well,
on the entire amount when they just needed 20 or 30,000.
Well, correct. But borrower A might be a long-term home that they really don't want to do that. Borrower B might be selling in a year or 18 months, and they're saying, heck yeah, this frees up, my budget. I save $450 a month. I now boost my credit score from a 680 to a 740 by paying off all my credit card debt. I'm just basically using up a little bit of my equity that I was going to pay off this debt after the fact, and I have a little bit higher of a payment, for the next 12 months. It makes perfect sense. So the biggest piece is getting a strategic partner, somebody who does have your best interest at hand, that, they don't just do a loan just to do a loan. It's somebody who's going to help maximize your money and put you in the best position possible going forward, and ultimately, hopefully, be your business partner and earn you as a client for life.
Yeah, I agree with you 100%. If you're a salesperson or a service provider, real estate, sales, or mortgage just has one tool in their toolbox, it's usually just sell or buy. So
Exactly.
That's not what everybody needs.
Correct.
And any other tips or thoughts on navigating the world of higher interest rates? The siren song of realtors is that you can always refinance later.
Exactly. So yes, you can always refinance later. I'm the biggest proponent is just because you can qualify for a payment doesn't mean you want it. Make sure before you hunker down and start looking seriously, you get live and actual updates of kind of where the market is. It's ever changing. Somebody who talks on a Monday, you might follow back up the following Monday and the rate's a quarter or potentially 3/8 different. That's how volatile the market's, being right now. So you want to make sure that you have a variance with your payment that you're not going to be uncomfortable with. And yes, right now, I mean,
and that's you just have to be comfortable with adjusting your sales price or purchase price.
Absolutely. And again, that starts from up front when you get pre-approved.
Right.
You can go in $25,000 or $50,000 increments saying, hey, if you're buying up to 500,000, if a rate's 6%, if it's 7%, just so borrowers can see the spread and say, hey, if it's 6.5%, okay, well, I know my payment's going to move about $100 or $125. I'm fine with that.
Right.
And again, firm it up, especially if most business happens after hours and on the weekends, and being available for clients is key. And taking that text or that call or that email and saying, hey, here's where everything ended as the business day on Friday, or here's where it is right now, and being able to kind of give a pretty solid estimate. Assuming you get a tax estimate, which is kind of can be a curveball depending upon where you're buying and, tax rates and everything else, making sure that's accounted for. And you have a little bit of a buffer there because it's a third party that's not controlled, but it's a big piece of your payment.
Right. Any thoughts on any crystal ball shots on the market or things in general? It looks like people are seeking affordability, and affordability is going to be driving people's choices.
Absolutely. The biggest thing we typically see is, especially with election years, the economy tends to get slightly more favorable. Rates tend to be somewhat in line, so the economy is as good as possible when the election's coming around. That's something that we've seen. Unfortunately, the main election's about a couple years out, but there's so many factors with trying to keep inflation in line right now. And, again, whether this all happens in the next 6 months or 12 to 18 months, the market will come back around. And as long as you find the home that you want to be in, again, the old saying, you're married to the home and, you're dating the rate. So again, that you can move that around at any point in time, as long as it's going to put you in a good position to succeed.
Right. Cool. Well, look, thanks for the insight on it. I learned a few things. You want to tell people how to find you?
Yeah. Again, David Burroughs with NBKC Bank. My personal number, that again is on all my correspondence, 816-305-1187. My email is David.Burroughs, and that's B as in boy, URROUGHS, at N as in national, B as in bank, K as in Kansas, C as in city.com. And I appreciate it.
Cool. All right, David. Thanks so much. Look forward to talking soon.
Okay. Thanks, Marcus. You have a great day.
All right. Bye-bye.
All right. Bye-bye.
All right. Thank you, everybody, for listening to me and David Burroughs talk about mortgages. Contact David if you have any lending needs. He lends in all 50 states. His number is 816-305-1187. I found David to be an excellent loan person and figuring out solutions for the individual's needs. He's not trying to retire off of your loan, and therefore will tell you his honest opinion whether or not you need his services and what product you qualify for and best meets your needs. So I also have a video that I'll put in the link about a tool to get to figure your loan interest rate questions, compounding. That's in the links, and it is a short video I've done on getting a very inexpensive tool to start calculating compounded interest. So this is Marcus Tuttle, Simplified Home Sales. We'll see you next time.